74%. I have looked at a lot of concentration figures across SGX and regional plays. I have never seen a number that simultaneously represents the biggest opportunity and the biggest systemic risk in a single retail investor's portfolio. That is what stopped me on this one. Before we go further, I need to be honest about why I ran this analysis. It was not for the channel. It was because I realized my own industrial REIT holdings are more exposed to this foundry than I had ever consciously acknowledged. That realization changed the framing of everything you are about to see. Here we are looking at the stark reality that without this foundry, there is no iPhone, no ChatGPT, and no DBS app. In a global economy where most industrial giants fight for single-digit margin improvements, this foundry has quietly reached a level of dominance that defies standard market physics. We are looking at a structural monopoly that acts as the sole enabler for the artificial intelligence era. Now let us look at what this means for the global economy. This is not a participant in a market. This is the market. We are talking about a true silicon sovereign holding the keys to 74% of advanced node revenue. No other entity on the planet can manufacture these chips with consistent yield. The consensus narrative out there is completely obsessed with geopolitical headlines and what gets called the Taiwan discount. But it is failing to price a massive anomaly into long-term models. The forensic trail does not lead to a cyclical tech story. It leads directly to a toll booth on the only road to the future of compute. Let us look at how the market is missing this. The market is missing the actual structural reality. The consensus narrative is fixated on geopolitical noise, while the forensic reality shows a structural monopoly that is the sole enabler of the artificial intelligence era. For the Singaporean investor managing a transition toward retirement adequacy, this shift represents a fundamental realignment of the risk-reward map. The market still prices this as a cyclical foundry play, missing the fact that this is the absolute anchor of the next decade of growth. Moving to the specific macroeconomic backdrop of this story. We are operating in an environment where a 6-month Singapore T-bill offers a 1.47% yield, while the CPF special account remains a sanctuary benchmark at 4%. The forensic gap lies between the intrinsic value of the world's silicon sovereign and a market that deeply misprices it. The stake for a 45-year-old professional in Bidok or Toa Payoh is exactly this. This is not about chasing the next shiny object in a brokerage app. This is the portfolio's growth engine, identifying the monopolistic flaw when traditional yield-bearing assets are being severely compressed. Let us look at the absolute worst-case scenario. On the surface, the geopolitical noise makes this stock look risky. But the reality is that if this single foundry stops, the global economy stops. Your entire portfolio, from industrial REITs to bank dividends, will face a shock that no amount of diversification can fully absorb. We are entirely dependent on this one choke point. This is a concentration risk that institutional players are already positioning for, carefully behind the scenes. Let us step back and consider the broader implications of this bottleneck. The psychological gap between institutional rhetoric and raw data has reached a breaking point. Fund managers publicly debate the silicon shield and potential supply chain disruptions. The same institutions are quietly increasing their allocations to the only company capable of fabricating the chips that power their own trading algorithms. The market is pricing this foundry for a conflict it cannot survive, while ignoring a monopoly it cannot live without. The data shows that the artificial intelligence infrastructure phase is not a bubble. It is a total customer reorganization. The forensic punchline is simple. You are not buying a semiconductor stock. You are buying a toll booth on the only road to the future of compute. Let us trace how this impacts you directly. The cost of living in the Singapore heartland has a direct, invisible umbilical cord to the fabrication plants in Hsinchu. When we look at household expenses in Marine Parade or Jurong East, we tend to focus on obvious levers like electricity tariffs. The forensic reality is that an invisible artificial intelligence tax is being quietly integrated into every digital service and hardware replacement cycle we pay for. If the foundry maintains its 66% gross margin, the cost of that margin is eventually passed down to the Singaporean consumer. Your next smartphone, your next laptop, and even the cloud services that power your workplace are all priced based on this dead wall of chip manufacturing costs. Moving to how this affects your retirement calculus. The macro environment has created a unique tension with the 6-month T-bill yield at 1.47%. The sanctuary benchmark of the CPF special account at 4% becomes even more valuable. For an investor searching for yield in a declining rate environment, the forensic data suggests a yield trap for those who over-prioritize short-term cash over growth enablers. A 0.71% dividend yield clearly fails the forensic minimum yield hurdle of 4.7% required for income-focused sanctuary assets. Yet for a mid-career professional using an SRS account, This is the primary growth engine of the global economy, as Singapore's own semiconductor sector contributes 7% to national gross domestic product. The domestic heartland investor has a front row seat to this expansion. Turning now to your existing property exposure. The SGX sector most directly impacted by this silicon hegemony is found right inside our industrial REITs and electronics players. As the global footprint expands and Singapore aggressively positions itself as a critical node through budget commitments, the valuations of localized wafer fab parks become central to the portfolio. We are seeing a historic shift. The high bandwidth memory requirements for artificial intelligence and the expansion of advanced packaging facilities are creating a secondary safety net for specific SGX-listed industrial landlords. Your exposure to the semiconductor cycle is likely already embedded in your supposedly safe REIT holdings. Monitoring the health of the global foundry leader is the only way to understand if those distributions are sustainable over the next 18 months of sustained macro pressure. Let us examine the hidden demand shift driving all of this. The second-order effect that most retail investors are missing is the agentic artificial intelligence trend. As artificial intelligence agents begin to perform complex, token-heavy tasks, the consumption of compute capacity shifts from human-driven episodic demand to automated, constant stream demand. This shift fundamentally changes the utilization rates of leading-edge fabs. The broader market waits for a killer app. The infrastructure is already being consumed at rates that heavily justify revised 56 to 59% revenue growth projections. The forensic punchline is that the tokens being consumed by artificial intelligence today are the dividends of the technology sector tomorrow. Let us look at the hard data proving this dominance. This is exactly where the structural monopoly becomes an undeniable forensic reality. The advanced node revenue share sits at a staggering 74%, up from 50% just 3 years ago. That proves absolute technical hegemony. The gross margin is at 66.2%, demonstrating unmatched pricing power across the entire supply chain. Nvidia's revenue share anchors at 17%. Apple sits at 19%. Meanwhile, the Singapore 6-month T-bill yield is at 1.47%, a declining risk-free sanctuary. Quarterly capital expenditure sits at an unbelievable $14 billion, vastly widening the debt wall. This data confirms the fortress-like nature of this business. Let us look at how this moat is evolving. The single forensic linchpin that makes the rest of the market noise irrelevant is that 74% figure. When nearly 3/4 of a company's total revenue comes from technologies that no competitor can reliably replicate at scale, the moat has officially become a fortress. For a 55-year-old investor in Marine Parade, with significant holdings in CPF and dividend-paying blue chips, this number represents the ultimate insurance policy against technology obsolescence. If your retirement portfolio relies on global growth to sustain its dividends, your reliance on that 74% share is absolute. Moving on to the staggering financial scale of this operation. This figure, $56 billion in annual capital expenditure, is effectively outsourced to the world's largest technology companies. The immediate consequence of this absolute dominance is that the foundry can dictate pricing and force its own customers to fund its aggressive expansion. That is a phenomenal position of strength. This is not just corporate spending. This is building a permanent structural advantage that makes it mathematically impossible for competitors to catch up without destroying their own balance sheets. This level of spending permanently cements the debt wall defense. Let us map how this connects to our local SGX sectors. The forensic stance across our local universe points to cautious optimism for industrial nodes and firm skepticism for retail-facing tech. For industrial REITs like Mapletree Industrial Trust and Keppel DC REIT, the stance is supported. They act as landlords to wafer fab parks and artificial intelligence data centers, provided gearing stays below 35%. For electronics manufacturing, including Franken Group and Venture Corporation, the stance is heavily pressured due to their high dependency on legacy nodes versus the artificial intelligence shift. Watch carefully for inventory turnover slowdowns. Local banking is supported as they finance regional expansion, assuming interest coverage ratios remain above 4 times. Logistics and trade remain strictly neutral amidst shifting geopolitical corridors. Let us review the macroeconomic scenarios. The primary risk to the silicon sovereign thesis remains the pace at which the world's largest cloud service providers can transition to internal chip designs. The bull case, at 35% probability, sees agentic artificial intelligence demand exceeding fab capacity through 2028, with tech-heavy SRS portfolios seeing record net asset value growth as Singapore research and development spending hits 4% of gross domestic product. The base case at 50% involves geopolitical stagnation with margin dilution from United States fabs, resulting in stable industrial REIT distributions but noticeable volatility in quarterly tech dividends. The bear case at 15% envisions cloud providers shifting to internal processors, triggering a sector-wide 25% drawdown and SGX electronics layoffs. Let us look at the stress tests you need to run. A heartland investor should be directing 3 specific stress test questions at their own portfolio right now. First, what is the exact percentage of net property income in your REIT holdings derived from tenants in the semiconductor or data center space? Second, does your blue chip position have the actual pricing power to pass through the continuously rising cost of silicon taxes as the global foundry maintains its 66% margin? Third, does your concentration in the technology sector exceed the crucial 25% rule, leaving you exposed to a potential capital expenditure overrun scenario? Let us move to the highly actionable playbook. My personal sanctuary threshold remains 3.2%. A sustained macroeconomic shock does not change the floor itself. It merely changes how many assets can still clear it. In an environment where the risk-free rate is constantly shifting, the core forensic question is whether your specific retirement portfolio can sustain its necessary distributions through the inevitable cycles of the global semiconductor market. The shock absorption audit for the Singapore semiconductor landscape reveals a heavily split picture. We must rigorously evaluate our domestic anchors to understand the real layer of protection our portfolios possess before making any major structural shifts in asset allocation. Let us examine these domestic anchors in strict detail. Global Foundries maintains strong buffer headroom with its $4 billion expansion in Singapore, heavily focusing on specialty chip capacity that is notably less sensitive to leading-edge price wars. Micron's massive $7 billion investment in high-bandwidth memory packaging provides direct exposure to the artificial intelligence boom, but its shock threshold is tightly tied to the intense cyclicality of memory pricing. UMC's new fab expansion and the 700 high-value jobs it creates represent a significant strategic commitment. Yet the buffer runs out rapidly if capacity utilization in the legacy 22nm space falls below 80%. For the heartland investor, these domestic anchors provide a layer of protection, but they do not eliminate the need for strict forensic vigilance. Turning to what this means for accumulators. If you are an accumulator aged 50 to 57 and still drawing a regular salary, the forensic picture suggests a very specific posture. This foundry should be viewed strictly as a capital growth engine rather than a source of immediate income. Yes, its yield of 0.71% fails the sanctuary hurdle entirely, but its role as the foundational architect of the artificial intelligence era makes it a critical component for those who are still actively building their SRS or cash-funded portfolios. You cannot rely on this for monthly dividends. Domestic anchors provide only a basic layer, not an impenetrable shield against global shifts. Let us look at the ultimate defense mechanism here. The overarching goal is not to time the market. It is to acknowledge the massive debt wall that prevents any competitor from unseating the market leader. You need to monitor whether your portfolio has enough fortress assets like our local banks to buffer the volatility inherently found in such a dominant but high-stakes technology position. This debt wall defense is precisely what protects your core holdings. But a major drawdown investor warning applies here. If you are aged 58 to 65, you cannot afford to wait for a 5-year artificial intelligence supercycle to fully play out if it means enduring a 30% drawdown in your principal capital. Let us detail the immediate strategy for that specific profile. If you are a drawdown investor aged 58 to 65 and already living partly off your monthly distributions, your perspective must be entirely different from the accumulator. The forensic stance for this profile is to prioritize true sanctuary assets. That means confidently leaning into the 4% CPF special account or the 6.39% yield currently offered by DBS. The foundry's yield of 0.71% is effectively noise for your specific income needs. Your focus should be entirely on the sustainability of the industrial REITs that physically house these semiconductor giants. If you are holding a basket of SGX REITs for income, you must ensure their gearing remains well below the 35% ceiling. Moving to how we navigate these tight margins together. If you want the full SGX exposure watch list and the complete 5-layer forensic breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. While free subscribers read yesterday's story, our elite investors are cross-checking the next setup together in real time. This is about making sure you are the analyst, not the exit liquidity when these structural shifts occur. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The window is already open. We are looking at a critical 7-day embargo window before the broader market fully digests these massive supply chain realities. And Iggy's elite investors have the complete SGX exposure watchlist right now. Click the link in the description to secure your access. This 74% anomaly represents the most critical choke point in modern computing, fundamentally altering the risk-reward map for any Singaporean relying on tech-heavy or industrial REIT distributions for retirement. The market is distracted by geopolitical noise while completely mispricing a structural monopoly that underpins the entire global economy. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.